Hopefully I do not need to motivate too much the fact that over the last two or three decades, there have been numerous defaults in not just emerging economies, but also in particular in developed economies, including in Europe, in many economies that we would have used to consider, at least to some extent, safe. And I think it's fair to say that kind of those last 3 decades, at least from a research perspective, have to some extent revived the interest in understanding the nature of sovereign credit risk, and of course also the evolution of credit spreads, and of course that comes naturally with kind of some trading opportunities or potentials, hopefully. Now, something I like to look at is essentially a particular type of product that's linked to the credit risk of individual governments and states, which are sovereign CDS spreads, so insurance contracts that effectively pay off if a government defaults, or if there's a technical default, essentially, or some sort of credit event. Now, if you look at kind of even the safest economy, or those that are deemed the safest of the safest, even there you see variation that suggests that at certain times, kind of credit spreads on these individual countries has kind of spiked to kind of frightening levels. So this is a graph where I'm plotting the insurance premium that pays off essentially when a government defaults, in this particular case, the United States. And you see that around the Lehman Brothers crash, spreads there even went up as high as 100 basis points, right? And on a number of episodes when there was kind of the concern of kind of a US debt crisis, when the budget was renegotiated, well, spreads kind of spiked up quite substantially. Now, even, of course, in Europe, it's well known that we have kind of lived through a European sovereign debt crisis, but something that surprised me quite a bit is essentially that at the height of that crisis, you see this kind of big fat red line, which is the insurance contract or the premium that was kind of the trading on Germany, on the German state, and that was almost twice as much as kind of some of the other safe economies, including Norway or Sweden. Right? So some kind of gaps there that seem surprising, at least to me, as usually would consider Germany to be among the safest states. Now you might wonder where Israel is trading at the moment. I've also looked up kind of the CDS spread of Israel for this kind of particular talk, and good news is Israel seems to be doing fairly well. The most recent number from Friday was kind of the CDS spread was trading at around 58 basis points. So from that perspective, at least, it seems to go in the right direction. Now, I find it useful to kind of take some historical perspective essentially on the amount of sovereign debt that has been at default throughout kind of history. And this is a plot I took from 2 economists from Harvard that have actually studied this from an economic perspective. And what you see there on this graph is the fraction of countries that over the last 200 years has been default. I mean, I think the fraction of countries all across the globe that have been together at the same time and in default. Now, you can look at this also as the fraction of total world GDP. You're going to get a similar number. But again, you see this kind of big default cycles that even at certain episodes in history, you have as much as 50% of all the countries around the globe in default at the same point in time, right? Now, and kind of, if you look at these cycles of default, right, it's a little bit kind of scary, in particular if you think about the buildup of global debt and the growth of global debt that we actually see throughout kind of different economies and different continents of this world. So this is kind of the latest number I took from the Economist Debt Clock that suggests that, I mean, again, these numbers differ depending on which source of debt you look at, but at least from the economist perspective, we're talking about 61 trillion of US dollars in total public debt. That's right now reaching frightening levels in many economies around the globe, which is particularly highlighted by the red colors on this map. And it's something that, again, the same economists refer to as the quadruple debt overhang, so it's certainly something we should concern about, or maybe that could kind of lead to investment opportunities in the kind of a more traditional sovereign credit risk space. So it's definitely less techy than kind of on the other, it's not about machine learning, but still I think an old kind of traditional investment class that could be of interest. Now, again, of course, with the growth of public debt, there are these kind of synthetic instruments that give you exposure to the default risk of individual governments. And as we all know, kind of this market has essentially kind of grown, exploded exponentially. But of course, since the US kind of debt crisis that was kind of actually in which the CDS contracts were heavily involved, in the aftermath of that, we have also kind of experienced a big, sharp contraction, again, of this market. Now, what about the sovereign CDS space? Well, also the sovereign CDS space has gone down a little, but in terms of the fraction of the total market, it's actually growing. So these numbers kind of over the last 2 years have been fairly stable, but by now, among kind of a total market size of about roughly 12 trillion US dollars, right, the sovereign space takes up about 18% of that. Now, an interesting kind of fact or kind of observation from, if I have my academic hat on, when I look at these kind of individual insurance contracts, is that they tend to trade in different currencies. So if you take kind of these kind of insurance contracts on any of those economies out there in the world, you can typically trade them in the local currency as well as kind of in a foreign currency denomination. Now, I think the first reaction that might come to mind is, well, who would actually trade kind of an insurance contract in the same currency as that of the nation, so the local currency? Because if a government actually tends to default, well, you might expect that the local currency is actually kind of selling off, right, and it's devaluing, so any insurance payment in that local currency might actually be useless, right? But it turns out that, especially since 2010, there has been a market that has been developing in multiple currencies for these insurance contracts for various investment strategies. And again, from my understanding is this mostly from an observational perspective, but various reasons here that could be promoted for kind of using the local currency CDS is potentially kind of a macro hedge, which simply kind of for an individual country might be preferred to be trading in the same currency. Another reason that you might have is that regulatory kind of incentives to trade these contracts. So many kind of broker-dealers or banks essentially that face capital requirements, well, part of that capital requirements can potentially come when you have counterparty risk exposures to individual governments. So kind of if you're a bank that trades with the interest rate swaps with the German Treasury or the US Treasury, well, it tends kind of to be often the case that these kind of counterparty exposures are not collateralized, so you need to hold regulatory capital against this. And so the bank regulation actively prescribes the purchase of insurance contracts as a way to reduce that capital requirement. And here again, of course, the use of local currency CDS in that context is cheaper than another way. Now, just to give you kind of some kind of graphical perspective on this, these are just some numbers from a few of the kind of the biggest broker-dealer banks in the United States. And the gray bars that you see, they effectively represent for different quarters between 2009 and 2014, the counterparty risk exposures that these banks have towards treasuries of individual governments, so sovereign counterparties or quasi-sovereign counterparties, but that's the amount of counterparty risk that's uncollateralized. So again, those exposures require regulatory capital to be put aside, and then of course you can trade insurance contracts to reduce those capital requirements. And so the red bars that you see on top of this is essentially reflecting the amount of insurance that is kind of purchased to protect specifically against that uncollateralized counterparty risk exposure, okay? And so there, you just see kind of there's differences across these broker-dealer banks. It's just kind of indicative, again, of perhaps the use of local currency CDS that could potentially be trading. Now, other kind of reasons here are essentially during the credit crisis, there were many opportunities being picked up on creating credit-linked notes tied to government risk. And essentially, there often, again, you might want to kind of add on top of it a credit enhancement where you sell insurance contracts on sovereign risk, again, preferable to be in the same currency. Another kind of bullet point that I have up there are negative or positive basis rates. Also, again, prior to the kind of the global financial crisis, the basis across government bonds and CDS contracts was mostly kind of zero. But ever since, you have actually seen kind of a very big widening of the CDS bond basis. And if you want to kind of implement arbitrage trades that exploits the widening of this basis gap, essentially matching the currency between the bond and the CDS can again be preferable. So multiple uses that actually could explain why there's an active market that has developed here in order to take advantage of trading opportunities. Now, let me kind of for a second take on my academic hat here, and so what I tried to do here together with co-authors on an academic paper that I presented here this morning at the conference is essentially trying to understand what these kind of insurance contracts that trade in multiple currencies, what they can tell us about the interaction between government's default risk and exchange rate movements. And so essentially, the particular type of products that what we call quanto spreads, which simply reflects the difference in these insurance premia between those insurance contracts in multiple currencies, right? So these quanto spreads, they effectively reflect a premium that you can take on for the kind of the sell-off of the exchange rate, specifically in that moment when the government might face kind of a big credit risk shock. All right. Now, just kind of, without going too much into details, what are we trying to do in that work? Well, again, we're trying to understand effectively these interactions between an actual default event and exchange rate risk, right? So what are kind of the risk premia embedded kind of in these two interactions? And in that particular study, we'll look precisely at the eurozone market for a very specific reason, because, I mean, defaults by itself are rare events, but by looking at the eurozone, we actually observe only one single exchange rate movement, but that we see very wide cross-sectional differences in the level of these kind of quanto spreads across the different currencies, but also there's a whole term structure effect when we see kind of differences in prices across different maturities. While these are informative about the interaction of expectations of default risk with exchange rate risk at different horizons, and yet kind of all of these movements ought to be consistent or with kind of one common exchange rate movement across all of these currencies. Now, so we kind of do kind of a measurement exercise to try to understand those interactions by building kind of a term structure model to capture those movements that we observe in the data. And so then, in order to learn something about kind of the risk premium that's embedded in these contracts. So I'm going to come back to those numbers in a second. Now, here's just kind of a few graphs to give you a sense of how these products look like, right? So on the top kind of panel, what I have is just the CDS spread in US dollars for one particular country. Again, in the eurozone, the one that we typically consider to be the safest, Germany. And you see the kind of the white movements that you have in relation to various macroeconomic events. So you have the buildup of the credit risk, again, with the Irish kind of bailout that we observed. Then you had the first Greek bailout, later on the Greek default. And then the big drop again coincides with the moment that Mario Draghi actually announced that he would do anything he can to bail out any European economy. Now, the second panel essentially is just a graph that shows you, if you look at all the different countries in the eurozone and you kind of extract kind of a common factor movement across all of these, well, that common factor actually has a very strong interaction with the exchange rate movements. And that's particularly pronounced, right, contemporaneously. So there seems to be not so much kind of interaction at different leads and lags that we observe, but it's really kind of this very strong interaction between those two types of risk that seem to kind of happen kind of contemporaneously. And then so you put those two things together, right? So you look at the interaction between default risk movements and exchange rate risk movements, and then you get to what we kind of call this quanto spread, which is kind of the bottom graph, right, which reflects now specifically the premium effectively, or the difference in the premiums between these insurance contracts that trade both in this local currency and this foreign currency. Now, let me just give you kind of a quick primer for those who are not as familiar with how these products actually work, right? So here I'm just taking kind of the perspective now from a US-based investor because I'm based in the US. So you have an exchange rate that I denote ST, and so ST reflects the number of US dollars you would actually pay for 1 euro. So if kind of the exchange rate goes down, right, so it effectively reflects a devaluation of the euro. Now, this tau that's what I use to kind of to track the timing of default, and L is just the loss given default that you get kind of in case of an actual credit event. Now, the top panel would reflect now the local currency denominated insurance premium or a contract. The bottom panel would reflect the US dollar denominated insurance contract, right? And so you could imagine a trading strategy where you would buy the euro denominated insurance contract and you would sell the dollar denominated insurance contract, or the opposite, okay? And so in principle, you would like to match the face values of those two contracts. So if you think in the bottom here about a face value, just for simplicity, of $1 US, well, the way you would match that face value is, of course, just by taking the equivalent amount in euros. So you kind of have $1 divided by the exchange rate. And now, based on those two kind of insurance contracts, what you would exchange over the life of until the maturity of those contracts is effectively the difference in these two insurance premium. Right, so you would essentially kind of pay, or essentially because you're buying the US dollar, like the local currency insurance, you would pay the euro insurance premium. But at the same time, you would kind of cash in the dollar insurance premium, of course, which now in euro terms is kind of fluctuating it around because the value of it is going to depend on the fluctuations in the exchange rate movements. So that's kind of one type of risk that's embedded in here. But there's a second type of risk, and that kind of occurs in particular in the contingency of a default event. So if you look at kind of those dotted kind of boxes here, that reflects precisely the moment when you would have a default event, right? In this case, what do you get? Well, you effectively, in this contract, the payout will be the fraction of face value, right? That's kind of in default, so the loss given default, which is typically assumed to be a constant in the pricing of those contracts. Of course, in realization, it's not necessarily a constant. And in return, what do you get? Well, you would get the loss given default from the dollar contract, but which is now very volatile in euro terms because it depends literally on the value of the local currency at the moment of default. So this kind of interaction here precisely reflects the possibility of a big sell-off of the local currency precisely in the moment when a government actually defaults, okay? Now, another reaction that might come to your mind is that, well, why do we even need these contracts? They're fully redundant because it's very simple to replicate these contracts by a bond and kind of hedging kind of the currency risk out with a cross-currency swap. Well, the problem with that is that if you do this, it's not necessarily the same thing because in case of a credit event, yes, the bond distinguishes. The bond is gone from the portfolio, but you're still stuck with the exchange rate risk from the cross-currency swap, and in that sense, well, this is not necessarily a redundant security. Now, if you now kind of look at the different contracts in the eurozone, and here's just for a selected number of 6 countries, you essentially see that there's not just kind of differences in the level of these quanto-CDS spreads, so which effectively reflect the expected depreciation of the currency given the default event, but you also see kind of very kind of different movements across the term structure across all of these countries, right? And so here, just kind of for simplicity and for visualization, we scaled all of those term structures by their respective one-year spreads, which is why they start at the same point. But that clearly highlights again that there are very, very different levels in terms of these quanto spreads, but also these very steep, like different slopes of these individual term structures. And the interesting feature, again, what I mentioned is that even though you have these kind of very different patterns across the different countries, well, all of those kind of patterns of credit risk that's embedded in these term structures is effectively, or has to be consistent with a common exchange rate movements for the euro-dollar that we observed during that time period. And so we're trying to exploit that information in order to learn something about the interaction between these two types of risk in order to help us kind of understand or explain how large that risk premium is by potentially taking on the exposure towards the sell-off in local currency when there is a credit event. All right, so just kind of course, we have to kind of to build a model for this. I don't want to go into details, but essentially the multiple ingredients that we use. So we kind of take kind of a reduced form factor-based approach, where we have kind of currency factors, we have credit risk factors, and we try to see whether we can, whether we can estimate this model in a sufficiently satisfying way, such that it captures kind of these different movements in sample. And of course, that's kind of in sample fitting, but then we do this essentially using a select number of countries, and we're taking it out of sample as well to see how well we are effectively doing in fitting kind of this model out of sample for the remaining part of the eurozone. And essentially, the way we are connecting the exchange rate movements to the default risk movements is essentially to one specific component, is to the kind of the jump component, the exchange rate. So when we model kind of the euro-dollar movements, we allow for kind of jumps in the exchange rate. So it's well known that the exchange rates might jump every now and then. And so the assumption that we're making here is effectively that whenever kind of the currencies jump during this particular sample period, well, that's probably related to some movement in the credit risk of one of the individual countries. All right, so here's just kind of quickly a visualization of the fit. Right, these graphs kind of look very similar. Again, for just a selected number of 6 countries, we'll look at the entire eurozone. But essentially, I think, at least from our perspective, I think we're doing a fairly good job in fitting these entire term structures of the quanto spreads for the core countries, for example, the Germany, Belgium, and France, as well as for some other countries from the periphery, like Ireland, Italy, and Spain. Right? So I think the graphs for the other countries are going to look about similar, and overall, I think that the fit is fairly decent. Now, if you look at now the default intensities that are essentially embedded in this type of contracts, right, you can extract them from this pricing information also, and you see like nothing kind of which would not be expected that, well, in particular during the sovereign debt crisis in Europe, well, you have these default intensities that drive kind of these, the magnitude of these insurance premia, right, they're spiking up over different points in time, right? So, but also you see across countries very different kind of movements over time, right? In which point in time or at which moment in time they actually spike up, and also how quickly kind of they revert backwards. Now, one thing we're doing is essentially by linking the kind of exchange rate movements to the credit risk movements, we're able to kind of with some model assumptions to identify the credit risk premium that we can earn essentially from selling these contracts. And so the bottom panel here simply reflects the magnitude of the credit risk premium. So essentially how much the default intensity embedded in the pricing information is relative to the realized information from individual types of credit events and the exchange rate movements. And so again, this just simply reflects that over time, how this credit risk premium has evolved. Now, a few things. So other things we do with the model is essentially to identify the loss given default. So for those of you who are familiar perhaps with these markets, the standard pricing assumption is to fix kind of a constant loss given default that's in the ballpark of 75% for sovereign counterparties. In the corporate space, typically we're talking about a 60%, so a 40% recovery. Now, given that particular sample, we estimate this to be 41%. Of course, there's some confidence bound around this. So the loss given default here is roughly between 35% and 50%. Again, that's kind of the information we get from this particular sample. Now, what else? So there's a few things we can do now with the model. So once we have estimated, we can ask ourselves, well, what's the actual probability of a huge sell-off of this currency in case of a credit event? So obviously that comes out from simulated data that we have once we have kind of fitted our model to the actual events. And so a surprising and interesting kind of insight that we get is that when you do these simulations, you get that the probability of a major sell-off, so a major devaluation, which we define as a movement that's larger than like a 3 standard deviation sell-off, well, the probability of that happening kind of in real life, right, essentially, is actually not that high. So it's kind of only about 4%, right, again, which is information we source from the actual market data. But if you look at now at the prices, right, so at which they trade, you look at the risk-neutral kind of default intensities, well, it turns out that the probability of a major sell-off, like a 3 standard deviation move in exchange rates, given the default event, is actually 75%. So there seems to be a huge discrepancy between the true distribution of default events, or the interaction between exchange rate movements and default events, and these actually, and the risk-neutral ones. And so that suggests that there's a major risk premium that's effectively embedded in the differences between these insurance contracts, right, that trade in these multiple currencies. Now, another thing we can do is, and without going again into the details of these graphs, but essentially what we can do within the model is to ask ourselves, well, how kind of would such a trading strategy perform? Not directly a trading strategy, but how much would you potentially earn from a carry trade strategy where you kind of strip out the default event and compare that to now this kind of similar strategy where you would have jointly the movements of kind of the exchange rates as well as the default risk. So you take on both risks at the same time, right? Again, the fact that when there is a big kind of default event, how is the currency selling off? And so the difference between those two the strategies would effectively be informative about how much excess or additional return you can earn beyond a simple carry trade strategy, right, where you would kind of invest in one currency, like borrow in one currency and invest into the other. And by doing that, again, consistent with the evidence that there's a major risk premium, or the previous kind of findings that there's a major risk premium in these quantum contracts, we find that the risk premium can be up to 30 basis points per week in addition. So it seems effectively that these risk premiums associated with these products are really, really large. All right, so let me conclude on this note. So essentially, because I'm out of time, so the question is sovereign risk a new asset class, right? You might say it's kind of a very old asset class, but I think the market for sovereign insurance contracts has grown tremendously over the last 2 decades. Of course, it has contracted again since the crisis, but at least the share of the total market in the sovereign space is growing. Now, the sovereign risk market certainly interacts with exchange rate movements, and I think that has become very clear. but the big question is how does it interact and how much? And so at least we're trying to kind of to shed some light on these interactions and to have some quantification of the risk premia associated with these movements. And in particular, we use these financial instruments, so the quantum spreads, again, these insurance contracts that pay off in a sovereign default event and which trade in these different currencies to learn something about that interaction, right? So in our model where, of course, it's a particular case where we apply it to the eurozone, right? So, and it's a special sample period for which we have this data, right? So that has to be taken with a caveat, but essentially the information we get about this, what we call the twin Ds, so the interaction between default risk and exchange rate risk suggests that these risk premiums are very significant, and they're much larger than the credit risk premium itself or the carriage rate premium itself. And so these seem to be economically important risk premia. And one of the explanations is that, well, if we actually have an event where Germany were to default or France were to default, well, these would effectively be states in which our marginal utility is extremely high. And so therefore, the risk premium that we want to have to be able to kind of to take on that risk, well, that might be substantial.